James reluctantly arrived at the weekend trading seminar. He'd already given up on trading, or at least that's what he told himself after his last losing streak wiped out most of his account. The promise of financial freedom and passive income had lured him into the markets, only for the roller coaster of gains and losses left him exhausted and broke. He'd read every book, watched countless tutorials, and spent hours glued to charts. Yet here he was, no better off than when he'd started, feeling more like a gambler than a skilled trader. Approaching the seminar hall, James was reminded of every trading course, every webinar, every seminar he'd been through. He expected the usual flashy slideshows, motivational quotes, and promises of secrets to trading success. Instead, he found himself in a dimly lit room which was quiet, which was almost too quiet. A single figure sat at the front, a man in a plain suit with a reserved smile, a contrast to the usual showman. His demeanor was calm, understated. When he spoke, it was in a soft tone that demanded attention. "Trading is simple," the man began, "but almost no one can make it work consistently. Anyone know why?" James waited for the usual spiel, but the man said nothing more. Instead, he picked up a small, ordinary coin, held it up for everyone to see, and flipped it high into the air. Heads. He flipped it again. Tails. Then he tossed it to James, who caught it instinctively. "What's the coin for?" James asked, puzzled. "Flip it 5 times, the man said, leaning back with a calm smile. James shrugged and flipped it 5 times. Heads, tails, heads, tails, heads. He looked at the man, unsure of what he was supposed to take from this exercise. "Perfect," the man said. "Now, what if I told you that your next 10 flips would each land on heads?" James frowned. "Well, that's almost impossible." "Precisely. And yet, every day, traders bet like they know where the coin will land, convinced that they've cracked the market." The man took back the coin and tucked it into his pocket. "What happens if you believe, without question, that the next flip will be heads?" "You'd lose half the time," James replied, smiling uneasily. "More than that," the man continued. "You'd likely lose more than you gain because, in the market, every flip is tied to a lot more than just chance. Every flip is tied to your emotions, your biases, and your risk tolerance. The moment you believe you know the outcome, you stop seeing reality. You only see your expectations, and in trading, expectations are dangerous." The man paused, letting his words sink in as he scanned the room, his eyes finally settling back on James. Most people approach trading as if it's a series of certainties, but the market is a complex web of probabilities. Yet, traders, new and experienced alike, cling to predictions, ignoring what the market is actually telling them. They convince themselves they have insight, patterns, or knowledge that assures them of success, and when things go sideways, they react emotionally, trying to wrestle with forces they can't control. The truth is, anyone can trade, but few can handle the uncertainty that real trading demands. James shifted in his seat, feeling exposed. He had done exactly that, thinking he had the market figured out, only to spiral with each unexpected loss. The man continued, "A true trader doesn't approach the market with rigid expectations, but with adaptability. The coin is a reminder that every trade can go either way. And the moment you forget that, the market will remind you, painfully." Another participant raised a hand. "So, if it's all just probability, what's the point? How do we succeed if we can't rely on patterns or strategies?" The man smiled knowingly. "You don't abandon strategy, but you trade knowing each outcome is uncertain. You control what you can, your position size, your risk, when to enter, and most importantly, when to walk away. Over time, probability favors those who accept it. Success in trading isn't about winning every trade. It's about staying in the game long enough to let your edge play out." James sat quietly, the pieces falling into place. He'd been so focused on finding certainty that he'd ignored the reality of trading, It's a game of probabilities, one where success belongs not to those who seek to win every time, but to those who respect the process, manage their risks, and adapt to whatever the market throws at them. The man looked at James, a spark of understanding lighting up in his gaze. "The secret," he said, "isn't in knowing where the coin will land. It's in knowing you can't know, and building a plan that works regardless." Do you approach the market like James did, thinking of it as a series of guarantees, certain you've cracked the code, and certain you can generate consistent profits from each move? I know I felt the same way when I started out as a trader. In this video, I will share with you 5 key reasons why you're unlikely to make money from trading as things are, and more importantly, what you can do to change that. Let's get to it. 1. You are thinking in certainties, not probabilities. From James' story, you can see that he dove into trading with the confidence that he could crack the code of the market. He'd read the books, followed the experts, and spent countless hours trying to predict what the market would do next. If price went up 3 times after dropping, James convinced himself he had spotted a pattern that he could rely on. He treated the market like a puzzle that, with enough focus, he could solve. But soon enough, that confidence turned into disappointment, and those patterns became traps as he watched his account drain trade by trade. It wasn't until the seminar that the idea of treating trading as a probability game even crossed his mind. And just like flipping a coin, predicting the market's next move with absolute certainty is impossible. Understanding that trading is about probability means giving up on your belief that you can predict the market with accuracy. Instead of treating each trade as a win or lose bet, you have to see it as part of a bigger picture. A single trade might go either way, but over hundreds of trades, you'd have better odds if you approach the market with this probabilistic mindset. Seeing the market as a realm of probabilities rather than a predictable system also means we have to put our ego aside and start respecting the random nature of the market. Weather forecasters don't predict the weather with absolute certainty. Instead, they use historical data, current conditions, and complex models to assign probabilities to different weather outcomes. For example, a forecast might say, "There's a 70% chance of rain tomorrow." This probabilistic approach helps us make informed decisions. If there's a high probability of rain, we might decide to bring an umbrella. Trading is about making peace with the uncertainty, not mastering it. And that simple truth can change everything for you. Talking about change, this is where the next point comes in. 2. You are too attached to the results. When James first started trading, his focus was completely on the results. Each trade felt like a test of his abilities, and each outcome either validated or crushed his confidence. When he won, he felt invincible. When he lost, he felt like a failure. This is what most of us do. We focus on results, and this pushes us to take impulsive actions, often abandoning our strategies in an effort to win back losses or maximize gains. If a trade didn't go our way, we'd double down to try and fix it. But the more we chased after outcomes, the further we drifted from any kind of disciplined approach. In the seminar, James started to see things differently. The speaker pointed out that in trading, focusing on results alone is a losing game because each result is out of your control. The speaker stressed that real success in trading isn't about the outcome of any one trade, but about sticking to a reliable, well-thought-out process. To detach from results, you have to learn to trust your process, even when it doesn't give you instant gratification. Instead of seeing each trade as a make-or-break event, you need to view it as just one small step in a much longer journey. Start setting specific criteria for when you enter a trade, and even harder, when you will exit, whether it was up or down. This approach will keep you grounded, protecting you from the emotional roller coaster of the trading world. Number 3. You don't prioritize risk management. In trading, risk management is the bedrock that separates those who can weather the storms of the market from those who end up burned out and broke. Many traders, especially beginners, start off with dreams of hitting it big. The allure of high returns can be blinding, leading them to put too much on the line in a single trade or ignore warning signs just to chase a potential win. But trading is inherently unpredictable, and without proper risk management, even a small streak of losses can devastate an account, wiping out months or even years of hard work. Effective risk management means understanding and accepting that every trade carries the possibility of loss. No matter how much research, preparation, or gut feeling goes into a trade, there is always a chance it won't go as planned. The essential step, then, is to set limits. A trader should only risk an amount they can afford to lose comfortably, without derailing their overall financial stability. Many experienced traders follow the 1% rule, risking no more than 1% of their trading capital on any single trade. Personally, I go as low as 0.5%. This approach keeps potential losses small and manageable, ensuring that even a losing streak won't wipe out my account. Beyond just setting a percentage, risk management involves using tools like stop-loss orders to automatically exit a trade if it hits a preset level of loss. Stop-loss orders act as a safety net, helping traders stick to their risk tolerance without emotional interference. Proper risk management also plays a crucial role in preserving a trader's mental stamina. When you overexpose yourself to risk, losses hit harder emotionally, which can lead to anxiety, frustration, and even impulsive revenge trading. When you keep risk controlled, you reduce the emotional toll of trading. This keeps you focused, rational, and better prepared to make sound decisions on future trades. In the long run, effective risk management is what allows traders to survive in the market and benefit from the law of large numbers. 4. You keep searching for the secret. Many of us started our trading journey convinced that there is a secret formula or hidden strategy that will unlock consistent profits. I realized there is nothing like that after facing losses after losses. If you don't already know, there isn't a magical system that guarantees wins. The market is driven by complex and often irrational forces, one that defies any single approach. The real secret isn't in discovering a flawless strategy. It's in accepting that trading success is about developing a mindset that accepts that anything can happen. Strategies are helpful, of course, but no one approach will work under all conditions. The market shifts constantly, responding to global events, investor psychology, economic data, and countless other variables. Instead of clinging to the notion of a universal solution, successful traders realize they must constantly adapt, refine their approach as the market itself evolves. When traders release the belief in a single answer, they're freed from the exhausting cycle of endlessly searching for the next big strategy. They shift their focus to understanding market behavior, honing risk management, and practicing emotional discipline. Instead of searching for the perfect formula, they learn to read market conditions and apply the right tools for each scenario. When you stop searching for the secret, you will discover something even more powerful: a freedom to embrace uncertainty and a resilience to navigate whatever the market brings. It's this adaptability, more than any holy grail strategy, that leads to true success in the markets, and one of the ways to do this is what I will talk about next. 5. You don't ever sit it out. The power of sitting out is one of the most underrated yet transformative concepts in trading. Many traders feel compelled to be constantly active, as if being in the market is the only way to make money. But the truth is, some of the most profitable moves come from waiting patiently, rather than taking trades that aren't aligned with a strategy or ideal conditions. Imagine a trader, Jude, eyeing a forex pair that's moving erratically. He is tempted to jump in, feeling like any trade is better than none, but when he stops and checks his setup criteria, he realizes the conditions aren't right and decides to wait. Sitting out, while difficult, saves him from making an impulsive move that likely would have led to losses. This is the power of sitting out. Successful trading isn't about constant activity. It's about being selective and waiting for high-probability setups. By holding back, traders like James protect their capital and mental clarity, focusing only on quality trades that align with their strategy. Sitting out builds discipline, teaching traders to prioritize patience and precision over chasing every small movement in the market. In the end, this patience leads to better, more confident trading decisions, proving that sometimes the smartest move is no move at all. Trading success isn't a guarantee, but it's achievable with the right mindset and discipline. To reinforce this belief, I suggest watching this video where I share my journey from being a beginner to reaching where I am today. I'm sure it will be helpful for you. If you found this video insightful, please like, share, and subscribe so you don't miss out on future videos to help you become a smarter, more disciplined trader. Thanks for watching.